यहाँ का म्यूट क्यों करके रखा है यार? म्यूट बोल.
Just a minute. Yeah, can you hear me? Hello?
Remove the hand.
Then this would.
Okay, I understand.
hear me? On.
The
Is that okay?
Manjal sir, good evening, sir.
Hi.
Dr. Nya, how are you?
Good evening.
ठीक है sir, your frame is very good, sir. You're quite useful.
Right.
You become a
Hi, Ajay.
Hey, where are you? I can't see you, son.
I'm somewhere here, yeah.
Hi. क्या हाल है?
क्या हाल है जी रजनीश जी? How are you?
I'm fine. ये वीडियो का I can't see it. माइक म्यूट है क्या? ऑन कर दिया। ओके। कहाँ ऑन कर दिया? ऑन नहीं है। ओके।
Good evening, ladies and gentlemen, and a very warm welcome to the 7th SBI Banking and Economics Conclave. Under extenuating circumstances, we are hosting this conclave digitally this year, and we hope to make the most of this format. Every year, the focus of SBI Banking and Economics Conclave is to push the conversation forward on the key issues the businesses and economies are facing and what could be done to spur growth. This year, the biggest challenge that the world is facing is the COVID-19 pandemic and the challenges that the people are facing. So, policymakers and businesses are grappling with the issues of bringing economic activity back on track while protecting the people and promoting their lives and livelihood. Keeping this in mind, the conclave this year is centered on the theme of COVID-19 and its impact on lives, businesses, livelihoods, and the economy. We have an erudite gathering of panelists and speakers who will shed light on this topic. But first of all, let me invite Sri Rajneesh Kumar, Chairman of SBI, for delivering the keynote, the welcome remarks. Over to you, sir.
Thank you. Good evening, ladies and gentlemen, distinguished guests, Professor Danny Roderick, Shri Sunil Kant Munjal, Dr. Randeep Guleria, Shri Ajay Piramal, Ms. Ashu Suyash, Shri Ronojoy Datta, colleagues from banking and financial sector, members of the media. I extend a very hearty welcome to all of you to the 7th edition of the SBI Banking and Economic Conclave. The conclave is the flagship annual event of State Bank of India, a one of its kind in the industry. It has carved a niche for itself by selecting subjects that are contemporary and relevant. Since inception, our effort has been to create a body of knowledge that provides actionable roadmap to contemporary problems facing the country. Therefore, the conclave strives to bring diverse viewpoints, national and international, to deliberate under overarching theme of the conclave every year. I remember last year, I began my address by saying that we are living in testing times. With the benefit of the hindsight today, I am surprised that 2020 has indeed become a testing time for everyone across the globe. The reasons are not very difficult to search. The outbreak of the COVID-19 pandemic has created a massive economic crisis, and it surpasses the one created by 2008 crisis, and the virus has become the talk of the town everywhere, and there is hardly anyone who can claim that he or she is not impacted by the pandemic. Even SBI Banking and Economics Conclave has gone digital this year. Accordingly, this year's conclave is centered around the pandemic with theme Impact of COVID-19 on Business and Economy. Pandemics are so rare that even the documented history of past pandemics is only a cursory guide. Projections of the potential impact of the COVID-19 shock on economic around the world for the year 2020 vary widely. However, there is a broad agreement that the global economy will contract given the sudden halt to large swathes of activities and the resulting income loss in the manufacturing and services sectors across most advanced countries and emerging markets. Asian Development Bank estimates that the world could suffer between $5.8 trillion to $8 trillion
Hello.
losses, equivalent to 6.4 to 9.7% of global gross domestic product as a result of this pandemic. In India, economic disruption caused by the pandemic is of gigantic proportions. The dislocation of migrant labor and disruption in domestic transport has adversely impacted the agriculturists, business units, suppliers, and exporters. It is uncertain as to how the household will react to this loss in income due to pandemic. There are predictions that discretionary consumption and consumption on durable items may slow this financial year. You are already aware that banks have absorbed substantial shock due to COVID-19 through the moratorium granted on payment of installments and interest by the Reserve Bank of India. And this has been a prescription which has been adopted by central banks across the globe. On May 12th, the Honorable Prime Minister gave a clarion call for Atmanirbhar Bharat, a vision to make India self-reliant, and laid down 5 pillars of Atmanirbhar Bharat. Self-reliant India will stand on 5 pillars. Visible economy, which brings in quantum jump and not incremental change. Infrastructure, system based on 21st century technology driven arrangements. Vibrant demography, which is our source of energy for a self-reliant India. And demand. Hereby, the strength of our demand and supply chain should be utilized to full capacity. All this raises important questions for business. How to adapt and evolve? What will be the defining features of the post-COVID new format? What new risks would emerge and how would they be addressed? Just to name a few. Spread over not exactly 2 days, today evening and tomorrow till afternoon, this year's conclave will deliberate on many such relevant questions. Coming to today's proceedings, there are 2 sessions. First is, of course, a panel discussion on COVID-19 and impact on business, followed by a keynote address by Professor Danny Roderick, Ford Foundation, Professor of International Political Economy, John F. Kennedy School of Government in USA. I hope audience will find these topics intellectually stimulating and informative. I once again welcome all of you. Hope you will enjoy today and tomorrow's deliberation. And I also want to take this opportunity to thank all my co-panelists as well as all the participants who have registered for this conference, and truly the response has been amazing and in fact beyond our expectation. Thank you very much.
Thank you so much, sir. Economic downturns are not something new, and companies have been surviving them for years. However, complete standstill in economic activity has never been witnessed before, and the effect of this will be felt for quite some time. To discuss the impact of COVID-19 on businesses, I now invite our CEO panel, in which we have Sri Rajneesh Kumar, Chairman of SBI, Dr. Randeep Guleria, Director at AIMS, Sri Ajay Piramal, Chairman of Piramal Enterprise, Sri Sunil Kumar Munjal, Chairman of Hero Enterprise, Ms. Asu Suyash, MD and CEO of CRISIL, and Sri Ranojoy Datta, CEO of Interglobe Aviation Private Limited. Moderating this very promising panel is CNBC TV 18's Managing Editor, Ms. Shireen Bhan. Over to you, Ms. Bhan.
Shireen, you need to unmute yourself. Shireen, you're muted. Can you unmute yourself?
I have no control on muting myself or unmuting myself. It's all in the hands of SBI. So I'm hoping that they have unmuted me, and I'm audible now. If I get a, am I unmuted now? The smiles on your face. Yes, the smiles on your faces tell me that I am unmuted. All right, so let me do a do-over, so to speak. It's great to be back here at the SBI Banking Conclave, albeit a virtual one, and we are going to be talking about the impact of COVID-19 on business. I think Mr. Rajneesh Kumar set it up for us, giving us the context of the impact on the global economy as well as the impact on the domestic economy. We've just had the IIP print, and once again, we don't have a headline IIP number being put out. Of course, we do have internals, but the government saying it's hard to put out a headline IIP number. There are different experiences being shared by different sectors. If you talk to people who are dealing with the rural economy, tractor sales seem to be doing very well. There's some rebound that we're even seeing in sectors like aviation, but in many other sectors, there continues to be a significant degree of pain. Well, to put the lens on all of that, I have with me a very eminent set of panelists. So without further ado, let me give each one of you about a minute and a half to kickstart the conversation. And let me start by asking you, Mr. Rajneesh Kumar, since you have your pulse on various facets of the economy. You said two things. You said that the economic disruption in India has been of gigantic proportions. Can you put a number on that? The number that the IMF is going with is minus 4.5%. The consensus seems to be a contraction of 5% for India. When you speak of a gigantic proportion of disruption to the Indian economy, put a number to that.
You're still muted, Rajneesh. You need to unmute yourself, I think.
Yeah, can you hear me now?
Yes, we can. So go ahead.
Sorry. So, Shireen, what I was saying is that this predictions around number that I gave to all the economists, IMF, World Bank, Asian Development Bank, rating agencies. But on ground, what is happening and what we see, or what I see as a practicing banker, there are a couple of things. One is definitely the situation was very bad in April, and that is the month where huge disruption was caused to all the supply chains, and we were under a very severe lockdown. And after that, things have gradually started picking up, and May was better than April, and June there is a, I can see a smart pickup. All the data and the feedback which I get from the ground is that definitely in the rural areas, the impact has been much less. But for India, unfortunately, some of the states like Maharashtra, Tamil Nadu, Gujarat, are industrially advanced state. The impact of COVID is much severe in these states, and NCR, of course, included. So these are the hub of economic activity. And because of sometimes a partial lockdown, there is still disruption being experienced as far as the supply chains are concerned. And of course, as far as the FMCG is concerned, pharma is concerned, telecom is concerned, sectors where the impact is minimal. So on the whole, the impact was definitely huge and unprecedented, but the recovery has been, in our assessment, sharper than expected. But again, I think it is too early to say, and we have to watch for a few more months whether this trend of recovery can continue.
Okay, so you're saying that you are starting to see a recovery at least in the month of June, but Mr. Kumar, we're already seeing more lockdowns now being announced. You talked about the industrial states like Maharashtra. Just this afternoon, the Maharashtra government has announced a lockdown in the industrial belt of Pimpri Chinchwad. There was already a lockdown announced in Aurangabad. UP has announced a lockdown for the next 3 days. So what is going to be the impact of, once again, this stop-start approach that we are starting to see as the cases continue to rise? And more importantly, now the murmurs are starting to pick up on the moratorium being extended all the way to the end of the year. You know, you spoke about how the banks have been the shock absorbers and have had to take a large part of the shock to the system and absorb it. Do you believe that we are going to see the moratorium being extended to the end of the year? Is that something that you're already starting to factor in?
If I go by my book and the analysis of that book, people who have availed of the moratorium, that percentage is not very high. But ultimately, there would be a further extension of the moratorium. Again, it is very premature to make a prediction. But at the same time, I think Reserve Bank of India, they have data from a lot of players from the system and would take an appropriate call. But across the board moratorium, if you ask me, this is my view, it is not required anymore. Because 6 months moratorium, and they are now economic activity, even picking up, some automated relief is required, and which call will be taken by the Reserve Bank of India. But whether we would need across the board moratorium after 31st August, I'm not so sure about it.
Okay, so you're saying you don't believe there might be a need to extend the moratorium beyond the 31st of August, even though that seems to be the indication that we're picking up here in Delhi. But we will have to wait to see what the Reserve Bank and the government have to do on this one. Yes, sir.
What I'm saying is that across the board moratorium, which was given for 6 months, that may not be needed. But certain sectors need some relief, and that is where, based on the data which will be available with Reserve Bank of India, because the State Bank of India, I have data only about my bank, but each of the players in the financial system, their position is different. So at aggregate level, a calibrated response from Reserve Bank of India, that is what I expect.
Okay, a calibrated response, and that's important. So you're saying that a blanket moratorium for everybody may not be warranted after the 31st of August. Some sectors may require the moratorium extension perhaps to the end of the year, but that's a call that the Reserve Bank will eventually take. Let me go to Ronojoy Datta, because I would imagine that one of the sectors that has perhaps been most badly impacted is travel, tourism, hospitality, aviation. Ronojoy Datta, what is the situation on the ground? You have been allowed to restart services. In fact, now you've been allowed to go up to 45% of capacity. We did see that pent-up demand initially. What's the numbers telling you today?
Now we are flying only about 30% of our January capacity. We'd like to go higher, but as you know, there are various restrictions from the state. So Maharashtra has put a restriction, so has Tamil Nadu. Kolkata came up and then back down again. So all that is really hurting demand. But I have to tell you that we are quite encouraged by the growth in underlying demand. To give you an example, we're not allowed to fly international at all. But when you offer charter flights to the Middle East, there's so much demand for it. Similarly, here, even in the domestic markets, we see a lot of growth in the tier 2 cities. So very encouraged by the underlying demand, but these travel restrictions are really hurting.
Okay, the travel restrictions are hurting you. The underlying demand, you believe, is looking strong at this point in time. How long will you be able to sustain with a 180-seater aircraft operating with just 15-odd passengers? Several routes are operating with this kind of capacity utilization. So what is it going to have to mean in terms of you redrawing, network management as well as utilization?
No, actually, our loads are pretty decent. So there might be an occasional flight here and there, But remember, if it could be a one-direction problem. So I might have a Delhi Ranchi, which one way is 15 passengers, but on the way back, it's 180 passengers. So you have to look at the full rotation. And we see no problem on the demand side of the equation, frankly. If there were no restrictions, I would project that we are at 30% now. We should be at 85% of that capacity by early next year. That's what the demand curve is telling us.
Okay, that's what demand is telling you, which is good to hear. Let's see whether these restrictions are in fact removed. We have no clarity or visibility yet on international operations being allowed to restart. Let me bring in Ajay Piramal into the conversation. Mr. Piramal, you know, the big talking point when it came to NBFCs and HFCs was liquidity. Would you say that the worst is behind when it comes to liquidity? And are we now going to have to focus much more on the solvency part of the problem?
I think the measures that have been taken in the last few months, both by RBI and the banking sector, has improved the liquidity in the system. But I think we need to bring out a few more points. I think in this whole exercise, I find it's only the public sector banks that have really stood up to all the requirements of funding. When I see that the NBFCs and HFCs earlier used to get a lot of funding from mutual funds, from private banks, now that has virtually dried up. It's only the public sector banks that have done well. And frankly, State Bank, though it's their own conference, I have to say, has taken the lead in that. So liquidity has improved. To that extent, it has improved for the better NBFCs, HFCs in the AAA, AA category. The other ones are still suffering. So it's a mixed bag. And I think solvency was not a major issue earlier as well. I think it's liquidity which was more important. To some extent, that has been taken care of. At least the investable grade NBFCs, they're getting adequate liquidity today.
Okay, so that's good news. I don't think SBI or the public sector banks have much of a choice. They've been given a mandate that they have to deliver on. They've got North Block watching every move that they make. So I don't know if they have much of a choice there. But I've got Dr. Guleria here. Yes,
I want to say
Kumar,
this.
I know you want to come back on
not
that.
It is a business decision, and all the decisions, even if there is a certain expectation from the government side, but nobody has said that you have to be reckless. Nobody has said that you have to support somebody whom you should not be supporting. So these are all commercial considerations, and from the State Bank side, I am making a very categorical statement that we have never been fair weather friend. We have always supported the people whom we know, and we stand by them in good times and bad times.
I guess that's a sleight of hand comment there as far as your private sector peers are concerned. SBI, not a fair weather friend, has always been there through good times and bad. That could be your tagline for your next promo, sir, or your next ad. But let me bring in Dr. Guleria into the conversation. Dr. Guleria, many thanks for joining us. I think what most people here on this panel and others who are watching are going to be concerned about is what is going to happen with the economy because of the cases rising. We're probably going to touch 8 lakh in terms of the case number by the end of today. So the recovery rate has also steadily been increasing. The testing rate has also steadily increased. Now, how would you assess what is happening on the infection curve at this point in time and correlate that with the GDP curve?
So you're right that our number of cases are increasing, and we are still showing a rising trend. But the recovery rate is also increasing, and in many areas we're finding that the number of patients who are actually on a ventilator or requiring ICU care is actually coming down. We're seeing that in our own hospital in Delhi, where we've treated now more than 4,300 patients. There was a time when we had almost 800 to 900 patients admitted in the hospital. That has come down to 500. So it's a positive sign as far as Delhi is concerned. And I think many major cities will see some sort of a flattening or decline, but an overall decline will take some time. You're right, this has caused a major effect as far as the economy is concerned, and there is going to be what we call the new normal in terms of how the economy will start coming back, kickstarting, and how we will operationalize ourselves in this new normal where infection control will become more and more important. And thereby, there will be certain industries which will have a huge challenge because of the fact that they will have to work, or workers will have to come together, and infection control will be very difficult. And like you said, tourism will be hit in a big way. There are others which may also be able to do well. The IT industry and the media have done well. So I think it's something that we need to look at. But it's a challenging time for the country, and we really need to see how best we can have the economy going at the same time have good infection control measures.
Speaking of infection control measures, Dr. Guleria, and I think something that is now starting to bother people, we've seen this business of unlock and reopening and restarting of the economy, and now we're dealing with a situation where various state governments are announcing lockdowns once again, whether it's 3 days or 4 days or 1 week. The question is, are these effective tools any longer? Because you've already got a significant spread, at least in states where there is already a large degree of transmission. Is this making the problem worse? Because then you're denying people access to testing, you're denying them access to healthcare facilities. So do these 3, 4, 5 days of lockdown have any meaning at all?
So very short durations of lockdown really don't have much effect as far as breaking the chain of transmission is concerned. You need to actually work on a strategy where you're looking at two things. One is good public awareness so that there is social distancing, wearing a mask, hand hygiene followed throughout, and the people are, and you have to have strict regulation to see that is done. Because what is happening is, as the lockdown gets lifted, people seem to forget all of this, and you will have markets which are crowded, there are people sitting together, and the infection actually spreads because of this. So infection control measures need to continue even if the lockdown is lifted. And you have to have a very good strategy of being able to do close monitoring to see wherever a cluster is developing, and containment in that limited area would help. But that will have to be for at least 14 days so that the chain of transmission can be stopped. It doesn't have to be a lockdown of the entire city, but you can have lockdown in small areas, small containment zones, which will prevent clusters from developing in that area and the local transmission from happening in those areas. So that type of strategy needs to be developed. You don't need to have a 5-day lockdown for the whole city. That really will not serve much purpose as far as infection control is concerned.
Yes, absolutely. I hope that policymakers are listening to what you have to say, Dr. Guleria. But, let me also ask you this, because the last conversation that you and I had was about a week and a half or 2 weeks ago. And you had said that your expectation was that for cities like Bombay and Delhi, we could see a flattening out over the next 4 to 6 weeks. Do you believe that that still stands, that still holds?
So as far as Delhi is concerned, that seems to be the trend that we're seeing. If you were to see the number of cases, we had actually gone up to almost 4,000 cases a day. Now, for the last few days, it's actually less than 3,000. We've even had some 2,500 cases a day. So there does seem to be some flattening. My only worry is that we should be able to sustain it. And as has happened in certain cities, that should not happen. Bangalore actually had a lowering trend, and they opened up, and then suddenly, because of people not doing social distancing, mixing together, there was a surge of cases. This has happened in US. We see the classical example in the United States, where they showed that the graph was coming down, and suddenly, because of reasons where social distancing was not maintained, they're again seeing now almost 40 to 50,000 cases per day. So even when you are having a situation where your cases are coming down, you're improving, it does not mean that you can let your guard down. It does not mean that social distancing is no longer important or wearing a mask is no longer important. That is the message that I would like to drive home to everyone, because that's only how, if we do that, then we could have the economy opening up and still keep the cases to a low number, and we could actually be able to have our workforce back as far as industry is concerned.
Dr. Guleria, I know that you have another important meeting to attend. So let me ask you this before I let you go. And we were just speaking with the doctor who's in charge of the big jumbo COVID facility that's been set up at the NSCI Dome in Mumbai. And his point of view also was that what is working in that facility, which also has a fairly high recovery rate of above 70%, are the regular medicines. He said, all of this sort of talk of the very expensive medicines that are now being used for experimental purposes, etc., that hasn't necessarily been as effective as the 200-300 rupee kind of medicines that we've been used to dealing with virals previously. What's the experience on the ground now that you have been dealing with COVID for the last few months? What's working?
So in my mind, only two things seem to be really making a big difference. One is oxygen therapy, and the other is use of steroids. And we have been doing that. If you are able to use, and they are something which are easily available. The drugs which are being touted a lot, whether it's plasma, whether it's remdesivir or tocilizumab, have not actually shown even in international trials to be of very great benefit, and they are still investigational drugs. So I would say that if we are able to do good management of our patients in terms of early diagnosis so that they're treated early, they're put on oxygen therapy early, we are able to give them steroids if they require, and we do the standard management protocol that we do, it will make a bigger difference in decreasing mortality. And we've been trying to do that now with having contacts with various hospitals throughout the country, trying to bring the mortality down to less than 1%.
Well, that certainly is or has to be part of the management control strategy that we put in place, is to keep the mortality rate down. It's currently at about 2.7%. Let me go from the health of COVID patients now to the health of the economy and to the health of corporate balance sheets, and bring Ashu into the conversation. Ashu, many thanks for joining us. What is the data telling you? If I look at downgrades for Q1 of FY21, 3,755 versus 1,703 of Q1 of FY20. What would you worry about as you look at what's happening with the impact of COVID on corporate balance sheets?
Hi, Shri. I think, before I answer the question, let's look at the backdrop. Right?
Dr. Jamshed ko bulana hai.
We're talking about GDP contracting by 5%. Our analysis across thousands and thousands of companies across many sectors. Revenue growth being in the negative 14 to 17% for India Inc. and profitability going by about 25%. Now, clearly, that does tell us that demand is significantly impacted. And guess what? Pre-pandemic, we were seeing demand slowing down.
I also came to know
weaker than previous year.
And he has a history of depression.
You can't have
as a matter of fact, he came in the morning for the ward also.
Story.
And he's staying with his mother.
Very important thing that I'd like to point out.
So I don't know what happened. I'm also not able to understand why he suddenly.
Than upgrades. The reality is, if I first quarter of this fiscal being 6.5% versus 9.6% of Q4 of last fiscal. The challenge is that upgrades are very, very few. So, the quarter that just went by, we only saw 1.9% upgrades versus the previous quarter of 5.8%. And in reality, these numbers in a way are artificially held down because we are in the moratorium phase. And that's a good thing because that's something that was needed. As well as SEBI has asked all of us and given the flexibility for us to distinguish between COVID-related interim stress. So nobody is going by one day just because of this COVID period. We're really looking at a more long-term thing. And what we've seen happen more is a large number of companies placed on watch rather than being downgraded. And from our own rated universe, we've seen about 287 such companies. When I see this going, and it's going to be the real test when moratorium is lifted, And we rate through the cycle. So it's not just about a point in time. And actually, the outlooks really indicate where we are seeing stress and where we are going to see companies bounce back faster. I think clearly sectors like telecom and FMCG look very resilient, as do fertilizers. We see that in oil refining sector, oil and gas distribution sectors, pharmaceuticals for sure. So it's not gloom and doom across board.
It's not gloom and doom across the board. You talked about some of the sectors that are likely to be much more resilient: telecom, FMCG, pharmaceuticals, fertilizers, oil and gas. But which are the ones that would be most vulnerable, Ashu? And you also talked about how the moratorium perhaps has artificially put a floor of some sort. But when that lifts, what's the expectation, and which sector or sectors do you believe are the most vulnerable?
So, analyzing about 71% of the outstanding rated debt, if I think about it from a quantum perspective, where we are seeing maximum stress is perhaps areas which are pretty well understood. We're seeing it in the airline sector because that's been hit quite badly. We see it in the gems and jewelry sector because, again, there the impact is pretty strong. We are seeing it in auto dealers. We are seeing it in real estate. Now, point to note is all of these sectors are in the discretionary consumption, discretionary demand area. And with the outlook on recovery being weak and income levels also being in question, where people are worrying about, are they going to have a job, leave alone raises and things like that. This is where we see the maximum stress. Having said that, this is just about 4% of the outstanding debt. The other areas which we would watch closely would be power generation, roads and construction, because there it is case by case. And so what we are looking for is what is the strength of the balance sheet? What is the way, how do they have the ability to withstand a slump in demand? And what's the liquidity position? Because that's going to determine their ability to withstand this period.
In just a moment, but let me bring in Mr. Sunil Kant Munjal into the conversation as well. Mr. Munjal, thanks very much for joining us. Let me get a big picture view from you on how you see things shaping up now that we're in some phase of unlock across some parts of the economy. Added to the COVID uncertainty is the additional uncertainty of what's happening with India and China. We've seen fresh rounds of talks on possible hiking of import duties. There could also be bans imposed, at least in some sectors. All of this will add up in terms of disruptive impact. How are you viewing both these?
So I'd look at it from four different aspects, Shireen. One is what the government has done. Two is what industry has faced. Three is what the markets and consumption is telling us. And fourth is the action being taken by the state governments and industry now as they look at, one is getting through the current period, but also beyond this. Many companies have started to focus beyond this because it's clear that in the next 6 months to a year. So originally, early on, many of us were saying this will take us 2 years to get the economy back on track fully. Germany, as you know, put out a statement only 2 weeks ago, where they said they're going to take 5 years to get the economy back to the pre-COVID level. Now, that's a bit scary because Germany is the strongest economy in Europe. They have more tools in their armor than any other economy, at least in Europe. So if Germany is going to take 5 years, we need to do a little bit of a rethink ourselves as to what's going to happen in India. I'm a little bit wary of us getting lulled into this sense of comfort because the rural economy genuinely has done well. And both Rajneesh Kumar and Ashu referred to this. Tractor sales, two-wheeler sales, fertilizers, a whole host of consumption items in the rural areas actually have done dramatically well, not just well. I know companies are just showing 120% sale of last year, not 20%. But at the same time, large tracts of industry are way behind, including some which are at literally rock bottom. So we need to be a little bit careful. The consumption and demand has actually shifted to purely essentials. Even the agri-linked is actually in some form essential. What's going on is for the new crop. So people are buying tractors and things like fertilizer, seeds, etc., which they need right now. And so discretionary spend has not come back into the system at all right now because of the apprehension of where we are going and when we will get to any kind of normalcy. So we keep talking of this new normal. So in the interim, what businesses started to do is, one, to look at how every aspect of business can expose itself more to technology. And I'm also talking the most conservative and most traditional businesses are starting to look at technology as a driver for business. Second is a new model of efficiency, which literally every company that I know of is currently investigating for themselves. And third is a new cost model. And that I think is a good thing, because as we come out of this, we have to start looking at global competitiveness. Too often in India, we've looked at being competitive next to the neighbor, next to the next city or town or region or east or west. We have to start looking at India as globally competitive. The interesting thing is, just this morning, actually, we had a meeting. Haryana government has set up some kind of a task force to look at how to make Haryana more competitive for industry and for manufacturing. Punjab government has set up one right now, only a week ago, to look at how to induce more innovation and more startups. So it's interesting how you see states getting more innovative and looking at getting more competitive themselves. That's a positive thing. The negative one, which I'm not sure enough thinking has gone into, is what we will see in terms of job losses, I think is hard to imagine right now in terms of number. I think it will be quite scary. I'm not sure we've done enough thinking about the social fallout of that. So while you have institutions like State Bank providing a massive safety net to many businesses, but it's not enough. You need a much bigger safety net that's made available to the whole system. At the same time, you need to find drivers for consumption and demand to come in at the same time. You need the urban revival to take place, and you need a wider section of the industry start to look like it's moving towards some kind of normalcy. Normalcy is some distance away. So I am afraid I'm sounding a little bit more negative than some of the others, but I think we have to have a sense of realism about what's going on. The opportunity to innovate is fantastic, but the pain is very real right now.
No, the pain is very real, and I'm glad that you're pointing that out. But Mr. Munjal, I want to pick up on a couple of the things that you spoke of, and let me start by asking you about job losses, because you're absolutely right. You know, the information that one is getting is largely anecdotal. Now, you spoke about dealing with various governments. You're dealing with the Haryana government, the Punjab government. You're dealing with CII and other industry organizations. What is your own sense on how bad it will get? I mean, you know, we just did a dipstick as far as the BPO and IT services sector is concerned, and the expectation is that between 50 to 60,000, you know, including furloughs and losses, job losses, that's the number currently. So what's the expectation when you say scary picture? What's the number you're working with?
I actually don't want to give you the number that my office gave me. It is scary, actually. And they're talking of upward of 20%. That is something that we've never experienced, at least in recent history, or at least in living memory. And this is coming from three different sources. One is because of induction of technology. Two is the companies that have suffered severely in this period, and many have, as you know, especially the small and mid-sized ones. They're just scared to bring people back, to hire more people at this stage. They're saying our focus is survival right now. Is recovery is next, and then we will look at thriving. So in the meantime, they just want to push away anything that adds a penny of cost to the balance sheet. So I think we need to turn this into an opportunity. I don't know if I sent you, I just wrote an interesting note on this very problem creating an opportunity is a massive dose of manufacturing industrialization in the rural areas, because a lot of the people have gone back, are not going to come, while 40% will come back right away. Another 20 or 30% will come back in a year's time. But many people will stay back in the rural areas. We need to build a thriving rural economy, and we can. So post-harvest, artisanal skills, logistics, cold chains, there is a unique opportunity for India. And on the urban side, massive dose of automation, robotics, artificial intelligence to raise the overall level of efficiency in the Indian economy to take a quantum leap forward. So if we can turn this problem on its head, we have a real opportunity right now, but that needs some serious leadership at this moment in the system to actually make this happen. In industry, amongst policymakers, in the states, and in the think tanks. All of them need to put this together and all in one direction.
Absolutely, and it needs to be not just thought of, but also acted upon. I think that's crucial. Execution is going to be key. But Ronojoy Datta, if I could...
I'm sorry, let me just make one more point. You spoke about China a little bit earlier. Now, China is not a new opportunity, by the way. It's been around for 2 years. And who took the advantage? Vietnam did, Indonesia did, Bangladesh did, Brazil did, many others did. We did not. We have woken up to the fact, though. We've identified 1,400 companies, global companies right now, whom we are now trying to address one-on-one with specific customized pitches for them. And I think that's a smart thing to do. But more important is what is in it for them rather than what is in it for us. That's what will drive the decision. So overall, factors of production have not changed. The fundamentals of what makes a good business has not changed. What makes business successful is still the same. So we need to get back to competitiveness and making life real easy for business.
Yes, and I know that many in industry, including Ms. R.C. Bhargav, making that pitch, that focus obsessively on enhancing competitiveness, that is what is going to work, or you will continue to see the shift that we were expecting out of China to come to India, to the countries that you just spoke of. But Ronojoy Datta, let me ask you this, and I want you to pick up on the points that were being made there by Mr. Sunil Munjal. One, the issue of job losses and, not just aviation, but the allied industry, the ecosystem around it. What's your own expectation, given where you see demand, the restrictions, the decline in discretionary spending? What's your expectation of what it could mean in terms of employment?
Well, it's really an issue for us in terms of fixed cost. And I'll just go back to the point that Ashu was making earlier about our balance sheets being strong. So clearly when we have, as an industry, all airlines, almost 40% of our costs are fixed. So when there was a total lockdown, we were really burning through cash, as you can imagine, every day. In fact, at the worst point of the crisis, we were burning like 40 crores a day with no flying at all. So that's the number that concerns us, and that's the number we're trying to whittle down. And the more flying we do, the better that number becomes. Fortunately,
so how much better is that number, Mr. Datta? From burning 40 crores a day, what are you burning today?
Well, I have an earnings call coming at the end of the month, so I can't give you the number before that, but it's improving, needless to say. Again, we're trying to work that number down. Fortunately for Indigo, we've always paid a lot of attention to a balance sheet. Again, I think as Ashu was pointing out, there is volatility across industries, but the strong ones are the ones that don't give all the money away in dividends and share buybacks and so forth, but actually spend the money on strengthening the balance sheet. Indigo has been doing that over the years, and that is why I think we are one of the outstanding companies, if you will, in terms of managing through this crisis. Now to the issue of job losses. So we are very, very focused on our employee. And we are a customer service company. And we know that good customer service can only come through fantastic employee engagement and motivation and culture. So that is one of our holy grails, keep a strong employee culture. At the same time, we have this cash burn issue, and we're trying to balance the two. So far, what we've done is taken most of the hits through pay cuts, through leave without pay, and through that, we're trying to manage the process.
Okay, but that 40 crore number, that was what you were burning a day during the lockdown, has improved, but you are still burning. But, you talked about the strength of the Indigo balance sheet, but let me ask you about the health of the overall aviation market in India. We've already seen a shakeout, so to speak. But given what's happening globally, I think the last count that we had, 9 airlines have filed for bankruptcy. Some have already ceased operations. There are concerns about AirAsia globally, whether it can be a going concern or not. Auditors have red flagged that. What about the health of the aviation sector as a whole in India?
Yeah, so for India, actually, I see some upsides in this whole process. Part of the reason why Indian aviation has always struggled, and I'll point to Air India and to Jet, is because we had all these hubs around us that were way too overbuilt. Whether it's AirAsia in Malaysia, or whether it's Thai Airways in Bangkok, or the Middle East Airlines, they overbuilt their hubs and as a result drained a lot of traffic out of India. In the new world, in the new normal, because they rely so much on point to connecting traffic, those hubs will have to shrink. When they shrink, I think Indian aviation will actually do better. And if you notice, AirAsia, you've talked of AirAsia problems. Thai Airways has declared bankruptcy. Many of the Gulf carriers are reducing capacity. All that, I think, is overall a good thing for Indian aviation.
Okay, so you believe that this will in fact work to our advantage given the pain that we're seeing globally as well. But Mr. Rajneesh Kumar, let me come back to you. And many of the questions raised by Ashu, Mr. Munjal, Ronojoy Datta and Mr. Piramal are around what we will see as far as the larger economy is concerned. Now, you've been leading the efforts, whether it is from the credit guarantee side and all of the schemes that the government has announced. What is the indication, especially as far as the MSME book is concerned, and the larger question of NPAs? The last time that we spoke with you, you said that it would be, you would have better visibility on how high the NPAs may rise towards August. Now, given what you are seeing with the moratorium experience, as well as how the economy is doing, what's your sense on where NPAs could be?
Very difficult at this stage, even now, to predict. But looking only at the data of State Bank of India for the moratorium, it seems to be a very manageable situation. And there are a few reasons for that. One is what I am finding, that people are very cautious about increasing their liability. Even in the two segments, one is your what we call RAM, retail, agriculture and MSME, and other is corporate. If I speak about the retail, definitely we are finding a trend with our borrowers and clients that people are hesitant to increase their liability, and they have been paying it, and a large number of people are paying it. Even our SMA situation, SMA 012, prevailing as on 29th February, when currently we look at, there have been payments in those accounts and considerable amount of payments. So that is one trend. As far as the corporates are concerned, they have opted in for moratorium. But the intent is about preserving the cash, not about that they really cannot afford to pay in this period.
Okay.
So that is another trend which I am seeing. And what Ashu was mentioning, or what Mr. Munjal or Datta, they have all mentioned, is that one is that certain sectors would definitely need help. Aviation sector is one of them, tourism is another, hotel industry. So there are like gems and jewelry, there are certain sectors which would need help. And second is that in the last 4 or 5 years, a lot of corporates have deleveraged. And the bigger ones, they have disappeared.
Okay.
And most of the banks, their provision coverage ratio has gone up. So the resilience in the financial system is much higher than it was 3 or 4 years ago. So today, because if I sound optimistic, then there is a problem. So in today's scenario, and when the real economy is having trouble, as a banker, I don't want to be sound very optimistic on NPA front, but analysis of our book, which we are doing continuously, I am not over worried.
Okay.
So emphasis is on over. So I'm not over
You're
worried.
worried. You're not over worried. I'm glad that you have emphasized that very clearly. So the SBI chairman is worried, but not over worried. He believes that the situation is still manageable. But let me ask you a follow-up question, Mr. Kumar, or two questions actually. You said that you don't believe that a blanket moratorium is warranted after the 31st of August. Sector-specific moratoriums could perhaps be extended or will continue. Then what about the restructuring scheme? Because the expectation was that by August, you'll have clarity on which way books are going and then a restructuring scheme would come. Do you believe a restructuring scheme is needed, is warranted? Are we likely to get one anytime soon? And secondly, a slew of banks, including yours, are announcing capital raising plans as well. Is that because you're unlikely to get any money from the government? And you believe that it's better to sort of brace yourself before you have any adverse situation?
Too many questions in one question, but one by one. 6 months moratorium itself is a restructuring or refacement. Let us understand that. Because the payments which were due in the 6 months, particularly for the EMI or the term loan obligations, they all have been back-ended. So in a way, it is a mini restructuring across the board. Now what would be needed is, again, I'm saying sector to sector, company to company. And ultimately, any loan gets repaid. The first is intent to pay. And second is alignment with the cash flow. So today, if we are having a situation where airports, they have lost revenue to a very large extent. So even in that, some of them are in a position to pay, some of them may not be in a position to pay. So aviation sector needs help, in my view, and would need help. But everybody would not need the same kind of help. And that is what Mr. Datta mentioned about, that their balance sheet strength, their balance sheet management, it gives them confidence that they will be able to override this situation. So again, what I feel that nothing is required across the board.
Okay.
31st August, some enablers, some enablers would be required, but again, there are situations where RBI has already allowed reassessment of working capital and certain reliefs up to 31st March 2021. There are certain sectors like hotel, airports. They don't need working capital. It is all about repayment of term loan installments, and it can be aligned with their cash flows, but that we would know only when we come out of this situation. So today, if you ask me that whether any corporate is in a position to give us the prediction of their cash flows, so it is very difficult. So that stability of the cash flow or the capability to project the cash flows would be needed. And only then you can think of any alignment of repayments. Third are those accounts where they were in trouble even before March 20, before this March 20 or before the COVID situation. So wherever it is deep restructuring, where the losses are such that they are not sustainable and they have to be bifurcated and losses to be borne by somebody, either the corporate themselves, borrower themselves, or partly by the bank. So you have to very clearly put every situation, I am talking more about corporate, not about the individuals or this thing, into three categories: reassessment of working capital, whatever dispensation RBI has given, that would be sufficient. Second would be certain sectors where realignment of cash flows, and only term loan realignment would do the trick. Third is if there are losses are to the extent that they are unsustainable, then there is no other way but do a deep restructuring.
Okay. Okay, so that's the three buckets that you're going to be looking at, but very clear, no blanket moratorium, and the 6-month moratorium should be treated as a restructuring for at least most parts. Mr. Piramal, you know, if I could bring you in, sir, to talk about some of the sectors that do require, that are engines of growth and do require significant intervention. Now, what kind? We still don't know, because the government's view, especially on real estate, has been to tell real estate developers that, look, you need to clear inventory, and if that means for you to cut prices, so be it. Now, we haven't seen that happen yet. What is the way forward? What's the outlook? What's the way out?
I think we have to recognize the importance of the real estate sector for the economy, any global economy, and including India. Real estate is the one which drives the economy. Also, we must recognize that real estate is a big provider for employment. We talked about a higher unemployment. Real estate is one area where you can get employment, where even unskilled people get employment. You talked about the migrant crisis. These were people who were employed by real estate. Also, there are almost 250 other industries which are related to real estate. So we need to see that this sector gets a fillip. If you don't get that...
How, sir? The question is how? You know, the government is pushing the ball back in the court of real estate developers, saying, look, you need to deal with this problem first by bringing down prices.
I think prices is not going to make a difference. We have seen this enough. It is the demand. If there is enough, the demand has to be generated. I think people need to feel positive about investing. If every day in the newspaper and in the media you read that the prices are going to go down, nobody's going to invest in it. The biggest saving a person has in their life is real estate. And if you want the people to feel good about life and about them, you have to see that real estate prices are kept at a steady level. Otherwise, if I have a real estate, if I have a house and I feel that my price is going down every day, that's not a great place to be in. So the way to do it is really we have to ensure that, first of all, the permissions for real estate are given sooner. I think in cities like Mumbai and all, where the premiums and all the other government taxes have gone up so high, we have to bring them down, and you need to ensure that there's liquidity. I think ultimately you're seeing, even in China, if you look at the experience of China, post the opening up, post-COVID, actually real estate price sales went up. Even in Mumbai or in India, I'm finding that real estate, especially in the affordable sector, has already started picking up. So it's not a question of pricing. Prices are already pretty decent.
Okay, so if you're saying it's not a question of pricing, the affordable part of the market, which was already the only part which was seeing some positive traction, that is continuing. So let me then ask you, Mr. Piramal, because you talked about demand generation. Now, what is it that you would like to see as next steps? And we don't know when those next steps will be unveiled by the government. The view so far from the government has been that, look, let unlock happen, let there be some resumption of business before we consider demand generation solutions. Now, what would you like to put on the table?
I think it's just also a matter of confidence. People need to feel confident that they can spend. Today, you are seeing that there is some uplift of certain industries, but my worry is that if the demand is not there, that is the biggest challenges for us to ensure that once we've settled the issues today, demand is taken care of. Whether it means that people get more money in their hands to spend, they get confidence to spend, that's what's needed.
Okay, confidence is needed. Ashu, let me get you to react to what you've heard from all of our panelists, as well as what we just heard there from Mr. Rajneesh Kumar, saying that he's worried but not over worried, and the NPA situation will be manageable. You know, in our conversation with the former RBI Governor Raghuram Rajan to my colleague Lata, he said that the NCLT should be working 24/7 these days, and he expects an avalanche of cases to the NCLT. Is that your expectation as well, Ashu?
So a couple of things, right? And this is really picking up from what SBI Chairman has also said. If we think about it, and I look at it, banking sector as a whole, we are seeing an uptick in NPAs. We see them in the region of probably 11.5%, which might be like a 15-year high or something like that. But it's nowhere close to the levels we would have seen in the 90s. So, you have to look at the problem that we're going to see in this crisis versus, let's say, what we had seen in the 90s post the 91 emergency time. So, per se, the economy looks in a better place. It's much larger. There is a lot more resilience. The evolution of the equity and credit markets and debt capital markets is much better. It's also a destination that's able to attract capital. The way we look at it is there will be an uptick in cases as far as the NCLT goes. And it's not just pandemic induced, but the fact that right now for 12 months, you're not taking up anything. So there is a natural buildup. There is something that is going to happen because of the pandemic. I think a very important thing that will need to perhaps be looked at is as the moratorium gets lifted, perhaps some kind of a COVID specific, whether like SBI Chairmanji said that there should be maybe extension of moratorium in select sectors, or perhaps a COVID oriented restructuring for viable businesses. See, it's no point throwing money or investing in businesses that are not going to be viable. And in that sense, there are really 3 or 4 things to consider. One, what's going to happen to demand? The reality is we went into this pandemic with slowing consumption, with employment being in question, and we did some analysis and the numbers don't look good at all, because analyzing 40,000 companies across 50 sectors with a wage bill of 12 lakh crores, we see vulnerability in 52% by size and 68% by numbers.
Wow.
Right? That should tell you something. Now, this is not all layoffs, this is not all redundancies, but a sharp cut in the paycheck, right? Combination of several things. Now, that simply means that recovery is going to be slow. And we are actually saying that even in 3 years, we are not going to come back to the pre-COVID levels from a GDP growth perspective. So we're actually talking about a 10% permanent loss in GDP. Now, by definition, this is going to happen in sectors that were vulnerable going into the pandemic and have become more vulnerable. And there's a sector impact. Obviously, wherever it's a discretionary spend sector, it's going to be an issue. Second, it's going to be companies that did not deleverage going into the pandemic, because we had a whole period between 2016 and 19, which all belong to deleveraging. In fact, part of the reasons we saw lower downgrades this time round versus, let's say, the global financial crisis, like I mentioned, downgrades were only 6.5%. Then it was 29%. That's because the leverage levels were much higher than there is now. The other thing is about agility of management and companies to adjust to the new normal. First, we'll be adjusting to the lower demand levels, paring down costs, which is also what Mr. Munjal said. And finally, adoption of digital, because even in the manufacturing sector, this is the time to think about automation in different ways, turning out lower cost, smaller batches, and of course, using the opportunity for India to become an alternate production hub. If those things don't happen, because that's a very large part of the economy, only then would I say you will have these avalanche of cases happening. I wouldn't say at this stage it's a kind of a given.
Okay, okay. I get what you're saying, but important what you spoke of in terms of the recovery and that it could be protracted 3 years out, perhaps. Let me then get wrap-up comments from each one of you. And Ronojoy Datta, let me start by asking you, you, Nike, swoosh, what are you expecting in terms of the shape of this recovery?
Well, fortunately, we have a trend which is working for us, which many other industries may not be fortunate to enjoy. We will clearly see a shrinkage at the top end of demand, meaning people will be using Teams meetings, Zoom meetings, and travel less. And that's going to hurt the corporate travel sector. No question about that. Fortunately for us, at the bottom end, though, we see a lot of room for growth. And what is happening through all this is air travel is becoming more affordable because we are cutting costs, fuel prices are down, and there's this whole safety issue. Airline travel is safer than other forms of travel. And as a result, we see substitution from train and buses to air. So at the bottom end, we see growth, while at the top end, we see shrinkage. And as Mr. Rajneesh Kumar was saying, it's awkward to be optimistic in the middle of a crisis. But unfortunately, that's where I am. I mean, I hope people don't think, what are you smoking? But it's hard for me to be gloom.
They might want to smoke what you're smoking.
Because I think in 18 months from now, aviation will be back in track with growth. That's my forecast.
Well, that's good to hear, and it's good to have a diverse set of opinion and views, and that's exactly what we're getting on this panel. So I know that you've been optimistic right through this crisis. Once the restrictions have lifted, you want the restrictions to be eased even further so that you can actually get back to flying as you were pre-COVID. But Mr. Munjal, let me ask you, road to recovery, what's the expectation? What shape are you going with? Do you believe that it will take it will be slow and protracted, or do you believe that we're going to bounce back faster?
So Ashu stole some of my lines. First, it's going to be a rocky road back, by the way. So, and it's going to be uneven because there will be sectors which will not recover. Okay? That's the one thing, that's the one negative thing which is worrisome. Some companies will shut shop, and they will not even know why they've shut shop, by the way. They will not be able to recover. And a large number of them will be small and mid-sized companies. The businesses which we spoke about a little bit earlier will have a very quick recovery, partially because of base effect and partially because of pent-up demand. We saw this, by the way, in motorcycles and bicycles. It was unbelievable. They actually upped their target twice within the month. I'm sure you're aware of these numbers. And in tractors, one of the companies at 120% of the previous year already. So we are seeing this across different sectors. The overall recovery, I tend to agree with what Ashu is saying, is between 2 to 3 years for the overall economy. But we will see sectors come up very quickly. Again, to supplement what Ajay said a little bit earlier, there are some important sectors with large multipliers and large potential for employment, which are still struggling. And without support, they will actually not be able to fully recover in this time. So there is a need for intervention. Some of it is structural, which is longer term, a permanent requirement for the overall system. But some is for very much for this period as well. And I think we need to remain alert. The fiscal support that we gave, we pulled back that much from the budget of different departments. So on the fiscal side, we won't see any problem except the lower revenues the government is generating. So I think the government needs to be prepared, not just to provide monetary support, but at least 2 more doses, at least 2, by the way, of fiscal support sectorally, and maybe even at some point picking individual entities.
Okay, 2 more doses of fiscal support. Mr. Piramal, road to recovery, 2 years, 3 years or less, what's your expectation?
It's difficult. I don't want to make this thing prediction on that, but in continuation of what Sunil said, I think you will find that there are certain sectors which are going to do well. What's also important to recognize is in every sector, the stronger companies actually will become stronger. This is what I see, that consolidation is going to take place in whichever sector you're talking about. My concern is that we can actually build this Atmanirbhar Bharat a big way if we support MSMEs, and that's where the thrust should be, because that's where a lot of employment is taking place. As you know, the largest employers are there, and we are importing such ridiculous things like toys and Ganesh and all that from China. Why can't they be made in India? It's very easy. I was looking at some numbers, almost $5 billion of such goods can be easily made by our MSMEs. So let's put not only words, but just let's move towards that. I think if we selectively do it, I find that the recovery would be a more U-shaped one. I don't see a V-shape, but I don't see and it's not going to be immediate. Yeah.
Okay, a U-shaped recovery, and yes, to the point that you're making, it goes back to competitiveness. Whether it's making Ganesh idols or anything else, it will come down to how cost competitive Indian manufacturing can be. I'll give the host the final say, Mr. Rajneesh Kumar. So investment demand, what is the expectation, sir? Credit offtake, what is the expectation? I know that you feel that the situation currently is manageable. You feel more confident and optimistic. On both these parameters, what's the expectation?
So one is we need a lot of money to be spent on infrastructure. And infrastructure and construction, that can create a lot of jobs and that can create a lot of demand. And the question is from where the money will come. The question is that there are always some issues around infrastructure, whether those issues gets addressed. But the luxury demand or those kind of things coming in quickly, it remains doubtful. But the investment in certain key sectors and infrastructure being one of them, that can help in reviving the economy in a big way. And that is where the government's intervention becomes very necessary. Because in infrastructure space, because of the regulations, because of the dependence on the government for infrastructure development, the role of the government becomes very difficult, very important. And the revival of economy, more than anything else, can depend upon that. How do we revive investment in infrastructure and how quickly?
I'll end by asking you, Mr. Kumar, Mr. K.V. Kamath was speaking to us and he said that the only way for banks to emerge out of this problem will be to, in a sense, bank their way out of the problem, to grow their way out of this current problem. So do you believe that that is something that we are going to see sort of a return to risk appetite for banks across the board, not just yours, but across the board in general? And also interest rates. Where do you see interest rates? How much lower do you believe that we can see interest rates headed?
That again, we will leave to the monetary policy of RBI in August. But
what's your sense?
My sense is that
given where your deposit rates are, what do you believe is we can go?
So they're not going to go up. Interest rates are not going to go up for sure. For some,
there's no question of up. How much lower are they going to go?
That is anybody's guess. But we are in a soft interest rate regime, and that is what is required. The cost of money has to come down. But again, I'm telling you that my experience is that only interest rate lowering does not lead to the investment, and there are many other things. And we have come down quite substantially on the interest rate, but that has not led to any revival of the investment. So this country also needs, apart from debt capital, lot of equity capital, and from where that capital will come in, that is the issue. And private capital can come in only when the investor is assured of a return and no hassles. And that is where the role of the governments become very important. Not only central government, but the local and state governments become very important. So interest rate is only one factor. You make it zero and you expect that investment will pick up. It will not happen.
That's a categorical assertion there from India's largest banker, saying that even if I bring interest rates down to zero, it doesn't necessarily mean that there will be an uptake as far as investment demand is concerned. And I think there is merit in what he says. But of course, the call and the clamor continues to be for rates to be brought down further. Well, we've got two optimists and two realists on this panel. I think Mr. Piramal is somewhere in the middle. So it's been an engaging and insightful conversation on which way the economy is headed, how long it will take for us to see a recovery, whether it will be U-shaped or V-shaped. I think consensus on this panel is that it's likely to be a shallow U-shaped recovery that we are going to see. But intervention is the need of the hour, which essentially means the ease of doing business, not necessarily more fiscal stimulus, though Mr. Munjal has said that 2 more doses of some kind of fiscal support will be required along with additional monetary support. And Mr. Rajneesh Kumar is absolutely clear that we will not need a blanket moratorium. Some sectors may need additional help post August. Aviation is in a sweet spot. If the restrictions are lifted, demand is looking strong. And Mr. Piramal believes that more needs to be done to get the engines of growth going as far as real estate and infrastructure is concerned. No avalanche of cases to the NCLT. That's the view there from Ashu Suyash. Many thanks for joining us here on this inaugural session of the SBI Banking and Economic Conclave. We appreciate your views. Thank you very much for your time. And of course, do stay tuned to CNBC TV 18. We'll be getting you the RBI governor and much more right here. For now, thanks very much for watching.
Thank you.
Thank you.
Thank you, Shri. Thank you, everyone.
Thank you.
Thank you, sir. Thank you so much.
Thank you.
And has made immense contributions in the areas of globalization, economic growth and development, and global economy. I welcome Professor Danny Roderick, Ford Foundation Professor of International Political Economy at Harvard's John F. Kennedy School of Government to deliver the keynote address. I also welcome Shri Dinesh Kumar Khara, SBI MD for Global Banking and Subsidiaries Business Vertical, who will be moderating this session. I request Shri Dinesh Kumar Khara to extend the welcome to Professor Roderick on behalf of SBI. Over to you, sir.
Thank you. After an insightful discussion on impact of COVID-19 on business and economy, it's time for today's keynote address. I'm happy to introduce to the audience Professor Danny Roderick, Ford Foundation Professor of International Political Economy at John F. Kennedy School of Government at Harvard University. He is an acclaimed and respected expert in the area of international economics, economic development, and political economy. Professor Roderick's research revolves around globalization, economic growth and development, and political economy. His current work focuses on how to create more inclusive economies in the developed and the developing societies. As we are aware, COVID-19 pandemic will the global economy very severely. Global trade in goods and services may contract sharply in 2020. Global value chains will get reorganized. India, which began its journey of liberalization in 1990, has seen the share of exports rising from 7% to 18% over the last 30 years, riding on the back of the brisk growth in the global economy since 2002. India's export witnessed a phenomenal threefold increase during the period 2002-2003 to 2007-2008. Our foreign trade and investment policy over the years have progressively become more liberal. Our peak tariff rates have fallen. India is an active member of the WTO and has free trade agreement with many countries. But at the same time, we have shown reservations in joining new free trade agreements such as RCEP. As we realize the extent of integration with the world economy, there is considerable scope to position India as a dependable location in evolving game of reorganizing global value chain following the COVID-19 outbreak. However, this powerful dynamo of employment generation is now threatened by a rapid contraction in global demand and weakening labor markets. It is a major challenge for India to implement strategies which not only mitigate the adverse impact of the global slowdown on its exports, but also build the resilience of the economy to such future shocks. In this context, Professor Rodrigues' today's address will discuss the impact of COVID-19 on global economy, trade, and outlook of emerging markets such as India in the light of the pandemic. I once again take this opportunity to welcome Professor Rodrigues to give the keynote address. Thank you. Professor Rodrigues, please.
Thank you. Thank you very much. Good evening to everybody. I want to thank the State Bank of India, Mr. Kara, Mr. Kumar, for having me, for inviting me to address this audience. I was listening to the discussion in the previous session, and I thought it was an extremely interesting discussion, and I was very happy to hear that there are at least some optimistic voices, and I think we do need optimistic voices. But I think the optimism was also tempered with a certain amount of realism about the difficult global and domestic context. I'm going to share my slides. I hope you can see my slides. The world, I don't think, is going to be the same after COVID-19, and we are very well aware of the immediate challenges in terms of economics and health that COVID-19 presents. India is still in the midst of a worsening health crisis. But what I want to argue, to put this in a kind of a longer term framework, and to outline some strategic issues that both the business community and the government faces, is that as big as the COVID-19 challenge is, it merely exacerbates ongoing problems, deepens existing tensions, and it's not going to necessarily change where we were going, simply makes the necessity of change much clearer than it was before. And I want to emphasize two dimensions in my talk about where the change is going to be needed. One is with respect to our existing approach to globalization, and I will call our existing thinking on globalization as a kind of a hyper-globalization mindset. And secondly, in terms of our growth strategy, in terms of our development strategy, that I think for a long time we've relied on a kind of an export-oriented industrialization model as an engine of growth. I know this is not what has driven India's economic growth in recent decades, and I will talk about that. But even for India, the idea of fostering rapid industrialization, export-oriented industrialization, has remained an objective, and I'm going to suggest that this is harder and harder to do, and that we need to think differently. So the basic point is that I think a change of course, both in our existing globalization model and our developmental or growth framework, was inevitable. And that we need to consider alternatives instead of thinking that we can return back to a status quo ante, because the status quo ante is in many ways broken and it's unsustainable. With respect to globalization, I'm going to suggest that what we need to think about is a return to what I'll call the spirit of the Bretton Woods period, the pre-1990 model of globalization, which in fact can be much more hospitable to the expansion of long-term investment and foreign trade than the specifics of the hyper-globalization model that we have pursued. With respect to our domestic growth and development policies in countries like India, I think there are the alternatives are not nearly as clear, unfortunately. But I believe that we may have to resign ourselves to a path of growth that is significantly lower than what India had become used to until very, very recently. And that this growth model will have to rely much more on creating jobs domestically, creating a middle class domestically, pursuing much more inclusive policies. It'll have to be driven much more by domestic restructuring and much less on external demand. So let's start with just a little bit about the world economy. We know, of course, that the world trade is experiencing a significant reduction. The WTO expects that in the first 2 quarters of this year, the volume of world trade has already fallen by around 20%. And this could go all the way up to about 30% by the end of the year. So the impact on trade is very severe. However, world trade was already on a path of growth, which was significantly less dynamic. So what I've shown here is the path that world trade was on before the global financial crisis of 2008, 2009. And you can see that the path, the thick blue line on which we have been on since, is actually a much slower growth than what we have. And there have been significant changes happening within countries. China, of course, which was one of the most significant engines of the expansion of the volume of trade and globalization, has already experienced quite a dramatic reduction in the share of exports to GDP. So its export to GDP peaked somewhere around 36%, just at the global financial crisis, has come down steadily to something around 20% now. That's a 16 percentage point reduction in the export to GDP ratio. India, we've just heard where Indian export performance since the 1990s has been quite astounding. However, India also has experienced a reduction in export to GDP ratio since the global financial crisis. It's a much smaller one than China's, but it's of the order of 5 percentage point of GDP, but it is still quite visible, and this decline has occurred since 2008. We see this also in trends with respect to global value chains. Global value chains essentially stopped expanding at the height of around, I would say, 2010, 2011. And what we have been seeing increasingly since then is much more kind of a regionalization of global value chains. So I don't expect that global value chains, even with all the emphasis on bringing suppliers back home, I don't think they're going to completely disassemble. However, there's certainly a trend of regionalization, and probably sort of 3 major hubs existing. One centered on China in East and Southeast Asia, one centered on the United States and the Americas, and one centered on Germany in Europe. You can see that presently India is actually fairly peripheral to those global value chains, probably closer to the European hub than to any of the others. I think if we think about why this last 30, 40 years of hyperglobalization has begun to come apart, and it seems it's not necessarily because of Trump. It's not because of COVID per se. As I said, these are ongoing trends. I think there are 3 fundamental internal tensions or internal contradictions of very advanced stages of globalization that we have been experiencing. First, with respect to the economics of globalization, there's always a trade-off between the gains that national countries, national economies reap from specialization, from producing fewer things for a larger world market, versus the gains that they reap from diversifying, producing many, many different things. And in fact, most countries get rich by diversifying rather than specialization. And at some point, too much specialization tends to become harmful. And too much specialization may also have other economic consequences, such as dependence on supplies, as in the present context, on medical supplies from a very few suppliers around the world. So there are some gains from productive diversification that put inherent limits to how much the logic of globalization can be pushed. Then there are tensions in terms of distribution, income distribution within countries. In the theory of economic trade, the gains from trade and redistribution, income redistribution, are two sides of the same coin. The more gains from trade, the larger the redistributive impact of trade. So you cannot reap the gains from trade, the aggregate gains from trade, increase the size of the pie without actually reshuffling income within countries between gainer industries and losing industries, and segments of the workforce that are advantaged, segments of the workforce that are disadvantaged. And managing those distributional struggles is a problem, particularly for democracies. And that's a second fundamental reason why globalization tends to slow down after a certain stage. And more broadly, there are issues about politics, that the hyper-globalization logic of trying to harmonize domestic economic policies so that such policies produce fewer barriers to international trade and international capital hit against the constraint that democracies and participatory political systems also require those policies to be responsive to domestic electorates and domestic stakeholders. So nations, electorates want diversity in terms of they want their own regulations and standards and laws that are appropriate to them, whereas a global market wants to have essentially homogeneity, one set of rules. And these two things come into conflict with each other. I think fundamentally, this is why historically advanced stages of globalization have always run into this problem of crises, of a backlash. And perhaps the first of these, and now I'm going all the way back in history, to the United States back in the 1890s, where there was a very vibrant anti-globalization backlash and of course the globalization at the time was the gold standard in the United States. And I think this is relevant because this is actually the first self-conscious populist movement in history, which arose in the 1880s, 90s in the United States. And that was a group of farmers that were being ravaged by high nominal interest rates on the one hand and declining commodity prices on the other, and essentially targeted the rules of the gold standard and the financiers in New York and the industrialists in New England as essentially the source of their problem. And so this was the original, if you will, backlash to globalization, again taking place at a point of advanced point of globalization. I think the good news is that let's see, I seem to have made a change here that prevents me from moving in my slides, which I think I clicked on something here. Let me see if this will work. Okay, yeah. The good news, I think, about globalization is that just because we're hitting into some natural limits in terms of where we are, does not mean that this is the end of globalization. Because globalization comes in a number of different variants. Since the original gold standard, we've had at least 3 different models of globalization. The first one was what I've indicated here, the gold standard. And we had a different mode of globalization, which I've called here the Bretton Woods regime between, let's say, the 1945 and let's say 1980s or so. And then the most recent version, the version of the post-1990 hyperglobalization. And I think the sense in which the post-1990 hyperglobalization model revives the original gold standard model is that it entailed a set of rules or practices that's reached behind national borders and increasingly constrained what domestic policymakers could do and how they could respond to domestic economic and social priorities. That was the original weak spot of the gold standard, and it's the weak spot of today's hyper-globalization. The Bretton Woods regime, on the other hand, was one that had been crafted with John Maynard Keynes as one of its architects. It was a regime that had been crafted with the goal of leaving significant policy autonomy for domestic economic policymakers in particular. So, of course, Keynes cared a lot about the conduct of monetary and fiscal policies to smooth out the business cycle. So he was keen to ensure that the rules of the Bretton Woods regime would, for example, allow countries to pursue policies such as capital controls that enable governments to pursue their independent monetary and fiscal policies. Similarly, under the GATT regime, the World Trade regime of the time, liberalization was a relatively shallow process. It was limited to reducing import tariffs at the border and eliminating quantitative restrictions on essentially just manufacturing. And those policies did not really reach behind the border into practices in subsidies, in agriculture, services, and intellectual property rights with respect to health and sanitary regulations and so forth, as the more recent vintage of trade agreements have had. Now, one might think that that more limited model of globalization, what I'm calling here the Bretton Woods model, would not have been very permissive in terms of enabling a significant rise in the volume of international trade, and that may not have been very conducive for overall economic growth. But actually, that is not true. So if we look at, sort of compare the Bretton Woods period with the hyperglobalization period, so let's say the period between 1950 and 1990, and I start this from 1950 because I don't want to bias my Bretton Woods numbers upwards by taking into the period of immediate recovery after the Second World War, and then the period post-1990 until 2015 as being sort of the period of hyperglobalization. You may be surprised to learn that in fact world trade expanded more rapidly under the Bretton Woods period than it did in the hyperglobalization period. And that world GDP, in fact, rose at least as rapidly, in fact, just slightly more rapidly than what we've had since 1990. So I think this paradox is resolved by understanding that a system of globalization that is modest in terms of, and then it explicitly allows nations to pursue economic and development strategies that are in line with domestic economic and social priorities, where the world economy is in the service of national economic objectives, is one that actually not only is better in terms of domestic social harmony, but it also actually enables faster growth of investment and trade around the world, because after all, countries that are doing well, where there is social peace, are much more likely to be open also to international trade and investment. So I think there is an alternative framework where we can place our model of globalization on a much more better, much healthier, more sustainable path that allows nations to reap significant gains from trade while maintaining domestic social peace. I think for developed countries, what that's going to mean is an explicit prioritization of rebuilding social contracts at home, which have frayed significantly. That will entail a range of policies in taxation, social policy, environmental innovation, labor market domains to support both a transition to a green economy, but also at the same time what I've called a good jobs economy. So a focus on productive employment in a green transition, with the world economy essentially supporting this, but also enabling nations to protect, if necessary, their domestic economic and social strategies through a variety of border policies that might be needed to prevent regulatory arbitrage or flows of short-term capital or trade that might undermine those domestic economic and social bargains. So that might mean, for example, policies that prevent social dumping through trade. It might be in carbon border tax adjustment policies. It might mean much greater management of capital flows. It might mean restrictions on inward foreign investment when there are concerns about integrity of domestic innovation systems or concerns about theft of intellectual property. I think for developing nations, there's a kind of a similar reprioritization of putting domestic development strategies first, at a similar opening up of space for domestic economic policies to pursue industrial investment policies to support economic transformation at home. And I'll say a little bit more about that in a second when I turn to the domestic economic strategy and growth. That doesn't mean that under this model, we would require necessarily less global governance or less focus on global public goods. In fact, most important areas for global cooperation are in non-economic areas, such as climate change, and in particular, as the pandemic reminds us acutely, in the area of global public health. That's where we need to build global institutions. And in a more narrowly economic domain, much better international coordination on tax havens, both with respect to corporate taxation as well as taxation of high income, high net worth individuals. I think in that kind of a world, we need to think very carefully about how China would fit. And I think the kind of globalization I've outlined would be one where there would be a system of peaceful economic coexistence with China, between the West and China, that there would be understanding, mutual understanding that on the one hand, that the United States and Western Europe neither have the right nor the ability to change the kind of economic system, the set of economic policies that have brought China so much prosperity. On the other hand, that China cannot necessarily rely on markets in the West that are always completely open if the consequences of such openness is to undermine social bargains or innovation systems in the West. So that will be a kind of a shallower integration model, more a WTO model. I'm sorry, more a GATT model than a WTO model. So I think there's a feasible path there between sort of these polar opposites of either deep integration or complete decoupling, and that there is a middle path there that's consistent with the spirit of Bretton Woods. Now, what I've outlined for you is a kind of a globalization that might work. It would be a retreat from hyperglobalization, but it would actually put globalization on a much healthier path. Now, it doesn't mean that that's necessarily what we are going to get. I think the good scenario, as I've outlined it, is one where we have this rebalancing between the national and the global that enables countries to repair their social bargains in the context of a healthy world economy. But there's a bad scenario, which would entail a 1930s style descent into trade wars, increasingly autarky. I don't think that's a realistic option. There's always a possibility, but I don't think that we are headed that way. So this is not what keeps me up at night. But there's also an ugly scenario, perhaps not as bad as the bad one, but certainly an ugly one. And that is essentially a kind of a continuation of the types of policies that Trump in the United States has pursued, that would involve continuous trade tensions, periodic trade wars, escalated conflict with China, that creates a global environment that is full of uncertainty and where investors and businesses cannot really plan ahead and there's a lot of arbitrariness in the system. And I think whether I think it's the good or the ugly scenario is more likely depends on sort of which side of the bed I get up from in the morning. But I wanted to indicate to you that there is, even if there's countries are going to start now in the West, in the United States, with a, let's say, Joe Biden administration, or in Europe with increased focus on domestic, on European industrial policies and a European Green Deal, there will be things that are happening that look like they're retreats from hyperglobalization. What I'd like you to think about is, what I'd like you to take from what I've said is that some of that is inevitable, and the question that faces us is whether that retreat is taking the form of the good scenario or it's taking the form of the ugly scenario, and how we would think of that will be very different accordingly. So let me now turn to economic growth and development strategy. We know that the developing world has been doing much better in the years before the COVID-19 crisis. And even though that growth was beginning to come down in many of these countries, including India, the last couple of decades have been very good for developing countries, and they've been growing much more rapidly than the advanced countries since then. But there is something in the nature of this growth, particularly of the very recent growth in countries like India, which has been problematic, and why I think we can't really return back to the status quo ante, or the previous growth strategy. Now, the traditional growth model that developing countries pursue is one where essentially we start in largely agricultural economies, where most of the workers are essentially farmers and peasants in the countryside. And the process of growth and development is driven by workers moving out of the countryside into sort of manufacturing, organized industry. And in this process, you get very rapid growth because organized manufacturing both tend to have higher productivity, so you can take a farmer off the field, turn him or her into a production worker, doubling or tripling his labor productivity, and that's immediately in national income, as well as the fact that manufacturing tends to be on a positive productivity trajectory. That is, once you start your manufacturing, your industrial establishments, they tend to converge towards the productivity frontier in the world. And so you have this dynamic that's going on. And of course, ultimately, you have the second big arrow. You have a process of deindustrialization sets in, and the workers that were previously manufacturing now start to move towards higher productivity services. So if you look at a country like Japan after the 1950s, South Korea, Taiwan, Hong Kong, Singapore, so there are very good recent examples of this process. What's happening today, including in rapidly growing countries and India as well in the last couple of days, is that in fact there's very little industrialization going on. The little industrialization that's going on, very little of it in terms of the share of employment, the share of the labor force that's in organized modern plants and modern firms in manufacturing is very little. Peasants are still moving, migrating into urban areas, but what they're doing mostly, as the thick arrow shows, is they're moving mostly into informal services, where their productivity is, for the most part, not that much higher to begin with. And secondly, services where they are not on this kind of a productivity trajectory, where they're not necessarily increasing, the dynamic is not to converge to a global frontier, as is the case in manufacturing. So where has this recent growth come from? It has not come from the traditional manufacturing led structural change. The evidence is that this growth really has been much more on the demand side. It's been a demand-led growth. And I think it's precisely because it's demand-led growth that it has resulted in a kind of an ultimately unsustainable model of growth. So I think my view of India is that it has been really driven largely by a kind of a ramping up of private investment since the 1990s, early 2000s especially. So investment demand has played on the private sector, has played a key role. Now, why has this happened? It doesn't necessarily happen because manufacturing or industry or modern services became very much more productive and that therefore sort of the return to capital necessarily rose. I think it was kind of a generalized improvement in expectations about the future of the economy. It was kind of what John Maynard Keynes would have called a revival of animal spirits on the part of private investors. That the change in the policy environment, a sort of a liberalization, opening up, that the expectations about the future productivity in the economy became that much more optimistic, and that's why we got a fantastic, actually quite a remarkable increase in private investment that went from somewhere like 15% of GDP in the mid-1990s to 26, 27, 28% of GDP until the global financial crisis, and of course has begun to come down. Unlike, of course, in the East Asian cases, where this kind of a big ramp up in private investment came with industrialization, with increasingly putting workers into manufacturing. In India, the farm jobs that were lost, that declined, the peasants that moved into the countryside found jobs essentially in urban services, in construction, in trade and hospitality, in transport, to a little lesser extent in education and health, but not in manufacturing industries largely. So that was sort of the Indian version of that big matrix of structural transition that I just showed you. Now, how does this pattern of structural change actually generate the kind of rapid growth India generated recently? Well, stick with me for a second while I explain to you what I think was going on. So I said that the start of this was a kind of an improvement in animal spirits. It has improved expectations about the future of the Indian economy. So that means you have this big increase in investment demand. That increase in investment demand, of course, has a direct effect on labor productivity. You're putting more capital to work with people. And that's going to get you certainly growth, but it doesn't get you the full growth that India was experiencing. So this is part of how India got growth, but it's not the full picture. The other part of it is that the derived demand effects of this increased investment demand, this private investment boost, was that as demand rose, it rose at the margin primarily for services like construction and others. So that pulled resources into some of these service sectors, where initially at least there was in fact a large or significant productivity gap between the countryside and agriculture and these services. So you got the second very important element of the growth was that you got this movement into somewhat higher productivity services like construction and commerce. And that not just added to the growth, but also in some ways validated the original expectations about higher productivity in the future, because as you drew resources into these more productive services, aggregate productivity also showed up higher. So this was a kind of a by your bootstraps kind of growth. That the initial optimistic expectations end up being self-validating. So this works for a while, but it doesn't work forever. And I think it doesn't work forever is that the sectors that are expanding, which are in the services, mostly non-traded services, which is where the labor is being absorbed, these services are not on a kind of a productive dynamic. That is, that productivity is not actually increasing significantly. So what we get is that as these sectors expand, actually we have lagging productivity in the rest of the economy. So ultimately, this process is self-extinguishing, that it just dies off. And then, of course, as the productivity slows down, then the investment demand also begins to slow down because the productivity benefits are no longer there. So I think that's why the kind of very good ride that I get, of course, this is my interpretation of India's story. It's also informed by processes that I've seen in other countries with recent growth boost going on. In some cases, it's been the public investment that drove this process. In others, it has been more private investment, as in the case of India. But so it's not surprising that this is coming to an end. I don't think once the Indian economy recovers after COVID-19 in 18 months or 2 years or 3 years, that it's going to be possible to go back to that same path. And so the question is, what are going to be the alternatives? Agriculture, I think there is still a lot of productivity gains that are possible in traditional agriculture. By moving into non-traditional products, by increasing the productivity inputs, irrigation, infrastructure investments, increasing yields in traditional agriculture. But agriculture is not going to solve the problem because ultimately, people will leave agriculture. It's very hard to imagine that agriculture will continue to absorb employment. And so the question is, where will labor go? They will have to go to places, to occupations outside of agriculture. Services, now India, of course, is a very strong, high productivity and tradable segment of services. ICT, finance, insurance, business services, along with the Philippines, India has been one of the winners of the ability to expand into tradable services in those areas. The trouble with those services, however, from the perspective of India, is that they are generally very skill intensive. They are not well aligned with the existing skill composition of the Indian economy, which is relatively less educated workers. So it's very difficult to imagine that these higher productivity tradable segments of services can absorb significant amount of workers, that's where the new jobs are going to be created in quantities that are needed, and therefore that is going to be the growth engine. There are other services which are mostly non-traded, I think are, for the most part, as I said, are not on this productivity treadmill. They're not on this dynamic productivity growth, on their own at least. So increasing productivity in those areas, in construction, health, education, requires some very difficult investment choices and policy choices on the part of the government. And we don't really have the kind of handle on how to get broad productivity improvements in non-tradable services as we do in the case of getting a few manufacturing sectors up and running and having them be the engine. So that's sort of my source of pessimism about where where the future is going to be. That it's going to require sort of different types of policies that are going to stress much more domestic services, creating jobs in those service sectors, but productive jobs and good jobs. And what we need to do there, I think, is going to require sort of a different kind of a mindset, different set of policies than what we think about when we think about normally turning outward and creating world-class manufacturing industries. So let me now try to wrap up and conclude. I think this is the specific problems I've talked about with respect to the growth and development challenge are not just India's problem. I think there is a global challenge that is being faced both in the lowest income countries, the middle income countries, and the advanced countries of the world. And that is that the process, that the phenomenon of economic dualism, that part of the economy is globally connected, highly productive, uses a lot of technology, lots of skilled workers, and the rest, which is less productive, where the low-skilled workers get absorbed, where firms don't have high productivity, don't use a lot of technology. This divide is not only stark, as it always been in the developing world, but it's getting starker. And it shows itself between advanced firms and the lagging firms, between the professionals and the low-skilled workers. It also shows itself spatially within countries, between cities and metropolitan centers that win and rural areas or smaller towns that are not winning. This phenomenon, which is, I think, of course, many developing countries are very familiar with, is also becoming a feature of advanced countries, and is something that will need to be addressed. And so that is at the root, I think, of the rise in inequality, and more importantly, the rise in economic insecurity in the countries, within countries. It's behind the backlash against hyperglobalism and the rise of the authoritarian right in many countries. It's also closely associated with this feature of what I call premature deindustrialization, that countries are no longer able to sustain high level of manufacturing employment, with the consequences that I've already described for you, which is the slowing down of the growth engine. So to conclude, I think COVID-19 is a significant inflection point in where we are, but doesn't change where we're going. I think one of the speakers in the previous panel said that this could be an opportunity. I think it is an opportunity for us to consider newer approaches, is to understand that we cannot return to the path that we were on before. I think there is going to be a kind of a reconsideration of the state, the role of the state, of public investment, collaborative strategies between the public sector and the private sector, that focuses on the creation of good jobs and broad employment for workers. I think there's going to be necessarily a retreat from hyperglobalization, but I think I've outlined how they could actually be put to a good use, is one that produces both social peace and harmony domestically, but also a healthy world economy. And ultimately, also finally, where in some sense I have the greatest number of questions that are unanswered in my own mind as to what the new growth model of the future is going to be. Not because of COVID-19, but because of all the trends that were already in place before COVID-19, which COVID-19 already exemplifies. The joblessness, the increasing unemployment, the disappearance of jobs in many sectors that COVID-19 has already caused. This is a generalized problem that already existed within countries, and that we will need to address. So let me. I've thrown out a lot at you. I hope at least some of this makes sense. I imagine. I don't expect you will agree with everything that I've said. I will be very disappointed if you were to agree with everything that I've said. So I look forward to the discussion that time will allow us to have, and I hope we do have some time. Thank you for listening.
Thank you, Professor. I think it was quite an interesting talk which was given, and the kind of perspectives which you outlined are really of a lot of value for all of us. In fact, the way you have described and the kind of focus which you have brought in is essentially for the domestic economy to be really strengthened. That is something which appears to be the prescription in the current kind of a situation immediately post-COVID. But only one thing which I would like to highlight is particularly for an economy like India, where we are always looking for the foreign capital. We invite the foreign capital. What are your views in this context? And and also at the same time, there is also a situation where a lot of liquidity is moving around the globe, and it is also looking for the destinations where it can possibly be put to the right use. So under that kind of a situation, what would be your views, Professor?
First, I mean, I would distinguish between attracting foreign capital in the sense of short-term capital flows and short-term loans versus longer-term investment. And I think one, longer-term foreign direct investment is something that can be very useful, and I think countries should encourage longer-term foreign investment because of the kind of supply chains that can develop domestically. So the multiplicative effects of foreign direct investment can be very large. I would be very cautious on financial liberalization of the capital of the capital account, which would make India a kind of a part of this global finance where there's a lot of money coming in and out, speculating on the value of the rupee and that kind of short-term capital has in general not been very advantageous for developing countries. It has not added up to domestic investment, to domestic capital stock. It has been a source of vulnerability, volatility, occasional crises. And sometimes, even though, the original motivation for opening up to foreign capital was to have a better discipline on government policies and fiscal policies in particular, many countries have found out that because short-term capital markets are very short-sighted, that they're chasing short-term yields, that availability of foreign finance can result in fiscal policy becoming more lax, less disciplined, simply because either you're able to borrow from abroad or you borrow from the domestic banking sector, which in turn is able to borrow from foreign financial markets. It makes the availability of foreign finance much more elastic and therefore enables bad fiscal policy. And of course, that always has a second stage when the sudden stop comes, and then that bad fiscal policy ends up typically in a kind of a crisis. I think the short answer to your question is long-term foreign direct investment, greenfield investments, absolutely. But caution on financial liberalization on the capital account and access of short-term finance.
Professor, I've got some questions from some of the participants also. So I would pose those questions before you to have your views on the subject. Of course, what is being perceived is that whether do you think that we'll continue to pursue the path of ugly scenario? And if so, will the decoupling be used more as a policy tool by the developing countries in the near future?
If you were to probably, ask me, to put a bet on the good versus the ugly scenario, as I said, the bad scenario is quite unlikely. But I think I would, probably, say that the ugly scenario is has a higher chance, at least in the short term. And I think that's going to, it's largely because I think in the United States, China is being seen as such a important geopolitical rival. And the US foreign policy establishment is, that's my reading, so unwilling to countenance a world in which there is some loss of relative power for the United States. So the United States wants to live in a world where, in fact, their power and influence extends to China's neighborhood as well. And China, I think, quite naturally is unwilling to countenance that. I don't know that China has global ambitions, and I don't want to comment on the conflict with India. But I think, unfortunately, the pressures that I see in the United States, against China, will almost certainly contaminate the trade and foreign economic relations realm at the same time. And that's why I think I see it more likely that an ugly scenario perhaps will result. On the other hand, all the indications are that Joe Biden will win the next election in the United States, and that's got to be better. As economic, he's been pushed in the direction of economic nationalism, but as economically nationalist as he is, it can't possibly be as bad as Trump. So I think that is the area where we can have some degree of optimism.
Professor, I've got Professor Ratin Roy, who is our director of NIPFC. So he would also like to address a question to you directly. So may I request Professor Ratin Roy, please?
Thank you, Mr. MD. Danny, that was fascinating. Thank you very much. I learned a lot from it. I have a simple question since you're Turkish. Turkey was a country that we were told built its economy, at least until recently, on the back of a successful manufacturing transition based on small businesses, and that seemed to have worked for a while. So to what extent do you think the Turkish model, given that it's also a populist authoritarian state like many of us, affords a way to the future and can perhaps be an indicator of the kind of virtuous transition we want under somewhat more restricted circumstances of globalization? I'm sure you'd love my question, sir. Over to you.
Thank you, Ratan. I don't think Turkey has a model, economic model. Certainly doesn't have a political model that should be emulated. But I don't think its economic model is one that should be emulated either, because I think Turkey is you're right about the transition to a manufacturing-led growth that started in the early 80s, and sort of lasted maybe about up to 2 decades. But from the 2000s on, I think what has happened in Turkey is that it's essentially it's a model that's been driven precisely by what I was cautioning against in my answer to the previous question, which is dependence on short-term capital flows. So as Turkey liberalized its external financial accounts and capital accounts in the financial sector in the 1990s, there's a kind of a wild sort of ride of the first domestic banks and increasingly domestic corporates sort of essentially borrowing from Western financial markets, and because you have this domestic interest rates in Turkey still remain, lira interest rates are very high, and within low interest rate environment in the rest of the world, despite the risk of an eventual sudden shock, banks and other investors have found it very profitable to invest in Turkey in the short term. And so that has created a kind of a model where Turkey, if you look at Turkey's growth, the only time when it was high is when it was running a very large current account deficit. And so it's not at all the Asian model, so to speak. It's not like an export-driven growth. It's actually a current account deficit-driven growth, foreign short-term capital inflow-driven growth. And anytime that flow comes to us, slows down, growth slows down. Not only that, the relationship between the size of the deficit and the growth you can have is also deteriorated over time, so that the same rate of growth actually requires now a bigger deficit. So if you look like in the last 2 years, they managed to bring the current account nearly to zero, but then the cost was completely reducing the growth rate of the economy. They began to grow just before COVID, but then the external deficit started to expand. So it hasn't had its final reckoning, and I have to admit that I've called the final reckoning for a very long time, and I'm really surprised that it's managed to go on for such a long time, partly because I do think foreign financial markets have given it a very, very long leash, but that I think the reckoning will come, and it will be ugly, and I think it's a very good model of what not to do in terms of how to get growth.
Thank you.
Professor, another question which is of lot of interest is actually has come from one of the viewers. This is relating to the debt trap which has been created by China by lending about 5 trillion at a rate which has been difficult to repay. And given the current COVID situation, it is impossible for such countries to repay this debt. What, according to you, is likely to be its impact on the global economy?
So the question is about Chinese lending to developing countries in the context of the Belt and Road Initiative and so forth.
Yeah.
So this is a major issue, and there's been very little transparency on that. I mean, I think this is a kind of situation where many developing countries, as much as they like to complain about the Bretton Woods institutions, multilateral institutions, will discover that it's so much better to deal with multilateral institutions as creditor, as opposed to having to deal with China as a bilateral creditor. And I think these countries will have to defend their national interests and make sure that they're not simply giving concessions to China and selling national assets at fire sale value, and these things become problematic not just from an economic standpoint but also from a political standpoint down the line. I think the thing to remember is I think it was if you owe somebody a little amount of money, that's your problem. If you owe somebody a lot of money, that's both your problems. And I think this is as much a problem of the creditors as much a problem of the debtor. And I think each country, and this will have to be resolved bilaterally, obviously, and countries will have to defend their interests. This is an area where I think we need significant more transparency about the nature of these debt deals, the arrangements, the workouts, and what's being negotiated. This is one thing that's a kind of unilateralism and bilateralism, which I think developing countries would really would be harmed by if we lose. I'm in general in favor of a multipolar world, but I think some of these multilateral principles I think are extremely important.
Thank you. Thank you very much. I think it has been a very, very interesting talk, and the kind of responses which you have got to the questions of our various viewers, it has been quite educative for all of us. So once again, I take this opportunity to thank you on behalf of State Bank of India and on my personal behalf for giving such an interesting presentation, and in such difficult times. Actually, we're all grappling to see how the economy is going to be, how the global economy is going to be in the days to come. So your thoughts are, of course, they have given us some kind of a visibility. Thank you, Doctor. Thank you very much, Professor.
Thank you very much. It was a pleasure to be with you, and good luck to you all.
Thank you. Thank you very much.
Thank you so much, sir. With this, we come to the end of the first day of the 7th SBI Banking and Economics Conclave. Thank you very much, everyone, for being present here digitally. We hope to see you soon, tomorrow morning, digitally again. Have a great night. Thank you.
Thank you.